I want to quickly talk about interest and how interest works in a mortgage. We all are worried about what our interest rate is. Everybody knows the key term of interest when it comes to a mortgage, but it's important to understand how that works over the life of your loan. Most loans we're doing for 30 years. So Nick Pakulla is with me today. He's my recommended lender here in the area, and he's going to break down how interest works and how you're paying back the interest on your loan over time. So Nick, take it away.
Yeah, sure.
Tell us how interest works.
I think the key point in this is that the bank is going to get its interest based on the current balance. So no matter where you are, let's say you're doing a 30-year loan, the term of the loan doesn't actually matter. The term sets the amount of principal that you're going to pay to make sure it's paid off in that time. But the interest piece, that's the one that the bank is always getting the same amount of interest based on the balance.
It's the same percentage. It's not the amount. It's the same percentage that they're getting.
Same percentage of interest on the remaining balance. So if you start with a $100,000 loan at 4% each year, if you weren't paying any principal down, the bank would be getting $4,000 or 4% interest back. Now, because they're fixed loans over a 30-year time frame, you will pay a little bit of principal every month. So that next month's payment is going to be based on the new remaining balance times 4%, divide by 12 to get to that next month.
So because when I pay my mortgage, some of that money in that monthly payment goes towards the principal. That's why it gets paid off in 30 years.
Right.
So because some of that money is going towards the principal, if I look at my first payment from my second payment, I pay less interest on my second payment because my principal has been lowered based on that last payment.
Exactly.
So the whole idea of paying off your loan early is adding you're getting rid of the maximum amount of interest by sending a new check in or sending. I've seen things lately about sending in your tax refund as a addition to the principal. And that takes years off, and therefore it's less interest.
Right. I mean,
based on the amount that's left.
Without getting too much into tax implications, I mean, it's again simple interest. It's not people get confused with the amortization, and there's a lot of things that will say, well, your mortgage is front loaded with interest, and I don't think that's really a true way to say it. It's literally just front loaded because you're borrowing
just bigger
more.
At that point in time.
More. So that
makes sense.
I think that's the key as well.
All right, so your interest rate is what it is. It stays what it is all the way through the loan, but it's calculated based on the balance that's remaining. So as you're paying down your loan, you're actually spending less on interest as you go through it. If you don't know what an amortization schedule is, you'll get one at settlement. It is literally the list of the 360 payments that you're going to make, how much goes to principal, how much goes to interest.
And it assumes that you just make the minimum payment every month.
Yes,
so the second
assuming
you pay extra,
all 360,000.
It's a different table, and you're taking months off the end of the payment.
Great. That's how interest works.